Markets are rallying into one of the most important Federal Reserve meetings of the year. But under the surface, traders are asking a much bigger question. Rates are expected to stay right where they are. No hike, no cut. But the real issue isn't what the Fed does this week. It's what comes next. The Dow, S&P 500, and NASDAQ all opened this week with bullish momentum. The Dow climbed over 300 points on Monday, pushing to 42,515. The S&P 500 and NASDAQ followed suit, gaining 0.9% and 1.5% respectively. Tech stocks surged. Risk appetite returned, and headlines echoed the same phrase, Fed weak optimism. But what exactly are investors so optimistic about? The Federal Reserve is not cutting rates. Core inflation remains elevated. Wage pressures persist, and the Fed's balance sheet is still in reduction mode. So why are markets acting like good times are ahead? To understand this rally, you have to understand the psychology of positioning. Over the past 2 weeks, hedge funds and institutional traders began preparing for a defensive summer. Volatility had increased. Oil prices were rising. Geopolitical tensions flared in the Middle East, and the bond market was signaling caution. Traders got cautious. They hedged. Some shorted the market. But then the unexpected happened. Oil prices dropped sharply as Iran signaled a willingness to engage in talks. Crude fell to around $71.77 per barrel. Bond yields stabilized, with the 10-year treasury hovering between 4.41 and 4.46%. And suddenly, the narrative flipped. Now, instead of worrying about inflation or liquidity, markets are betting that the Fed will eventually pivot. But here's the trap. Betting on what the Fed might do months from now is very different from reacting to what it says this week. And that's where the risk lies. Because while Jerome Powell is expected to hold rates steady, his messaging will be critical. If he emphasizes that inflation remains sticky and that rate cuts are not on the table for the foreseeable future, markets could quickly reprice. That repricing is the danger, because valuations are stretched, earnings growth has slowed, and corporate guidance heading into Q3 has been more cautious than expected. Yet here we are, rallying in the Fed week on hope. Let's talk about that hope. The soft landing narrative is back. Bulls argue that inflation is moderating, the labor market is resilient, and GDP growth is stabilizing. And in some ways, they're right. But hope isn't policy, and markets often confuse the two. As of June 16th, the U.S. national debt stands at over $36.2 trillion. Interest payments are approaching $1 trillion annually. The fiscal trajectory is unsustainable, yet it rarely gets priced into markets until something breaks. Liquidity remains constrained. The Fed is still reducing its balance sheet. Quantitative tightening is still underway. And while equities are rallying, credit markets are less enthusiastic. High-yield spreads have widened. Demand for corporate debt is cooling, and banks continue to tighten lending standards. These are not signals of a healthy, expanding economy. These are signals of a system under pressure. Now layer in the global landscape. China's industrial output came in below expectations. Europe remains on the edge of stagnation. Japan's central bank is shifting posture, and the dollar remains strong, pressuring global trade and multinational earnings. So what comes next? That depends on Powell's tone. If Powell signals that rate cuts are off the table until 2026, markets may panic. If he downplays inflation risk, they may surge temporarily. But neither path leads to a clear runway for sustained growth. Because the reality is this: the Fed is trapped. Cut too soon and inflation reignites. Hold too long and growth cracks. Powell has no good options, only choices with consequences. This is why traders are so focused on the press conference, not the rate decision. They want clues, language, tone shifts, any sign of a pivot. But Powell knows the stakes. He understands how tightly financial conditions are correlated to messaging, and he's shown a pattern of walking the tightrope, hawkish enough to maintain control, dovish enough to avoid panic. What's different now is the market sensitivity. After months of range-bound trading, risk assets are finally moving. Momentum is back. Algos are active. Options flows are aggressive. That means volatility can return instantly in either direction. And that brings us to the core issue, clarity. The market doesn't need cuts. It needs clarity. A roadmap. A signal that the Fed is in control and inflation is being managed without crushing growth. So far, that clarity is lacking. That's why institutional desks are hedging. Even as they buy equities, they're increasing put exposure. They're rotating into defensives. They're holding cash. Because they know what retail often forgets. Fed weeks are catalysts, not conclusions. A single phrase from Powell can rewrite months of positioning. And right now, markets are fragile. If Powell confirms a higher for longer stance, risk assets could correct sharply. If he implies a door is open for cuts later this year, the rally could extend, but so could inflation risk. It's a lose-lose setup for clarity seekers. And for traders, that means discipline is everything. Stay focused. Don't chase noise. Watch the bond market. Follow yield curves. And look for dislocations. That's where real edge lives, not in headline sentiment, but in price action reality. Because after Fed week, the illusion fades. And what's left is the data, earnings season, economic reports, global trade metrics, consumer credit trends. These will shape the second half of 2025 far more than any Fed sentence ever could. So don't get caught off guard. Stay sharp. Study the data. Think independently. Because the markets may rally into Fed week, but what comes next will test everything. And if you want elite-level breakdowns like this, grounded, fast, and always one step ahead, subscribe to Wealth Signal. We separate the signal from the noise so you can stay in control. Beyond this week's meeting, the Fed's roadmap remains deeply uncertain. While markets have been quick to price in a long-term soft landing, policymakers are facing a tighter needle to thread than ever before. The balance between inflation containment and economic support is more delicate now than it has been in decades. Many traders are now watching the bond market for cues that go beyond the Fed's language. The yield curve remains inverted, with short-term yields higher than long-term yields, a classic sign that investors anticipate slower growth ahead. Historically, prolonged inversions have preceded recessions with striking consistency. At the same time, corporate earnings will soon take center stage. Q2 results will begin to surface in just a few weeks, and analysts are watching for clues about consumer strength, margin compression, and forward guidance. Tech giants may carry the indices, but small and mid-cap companies will tell the real story. We're also seeing new patterns in retail investor behavior. Despite the recent rally, ETF flows show an uptick in defensive allocations, staples, healthcare, and dividend-oriented funds. That divergence between headline optimism and allocation strategy is worth noting. The housing market, too, is sending mixed signals. While home prices have stabilized in many areas, affordability remains at crisis levels. Mortgage rates have settled just under 7%, putting significant strain on first-time buyers and lowering transaction volumes. This drag on housing turnover is affecting everything from furniture sales to local tax revenues. Even employment, the last pillar of economic stability, is showing signs of softening beneath the surface. Labor force participation has plateaued. Temporary job postings are declining. And industries like transportation and warehousing are beginning to shed jobs, often a leading indicator of demand contraction. These signals aren't catastrophic, but they aren't bullish either. They point to a slowing economy that still hasn't fully digested the impact of 2 years of tightening. And they suggest that this rally, however sharp, may be resting on unstable ground. That's why clarity is so important right now, not just from the Fed, but from earnings, inflation data, consumer behavior, and global. And if you want elite-level breakdowns like this, grounded, fast, and always one step ahead, subscribe to Wealth Signal. We separate the signal from the noise so you can stay in control.